welcome to Best of Global Mantra Market Outlook 2015 with me, Tanvir, Gill. Now, 2014 has been a polarized year for the markets, with the US and select emerging markets like India and China doing well, while the rest of the world faced underperformance. Even when it comes to the broader economy, that divergence in economic growth was stark, with the US being the clear winner in this regard. The one common factor that underlined the world economic reality was falling inflation. From Japan to the US to emerging markets to mainland Europe, demand has been slowing, and that is having its impact on inflation prints. Europe, of course, being the most sensitive area to the risk of deflation or negative inflation come 2015. In the series, Global Mantra Market Outlook 2015, I spoke to asset managers who oversee collectively more than $4 trillion in total assets. That's right, $4 trillion, which is double the size of the Indian economy, and try to get their view into the new year. Now, 2015, in many ways, is going to be a turnaround year, at least in terms of monetary policy, if the Fed decides to hike rates. And also a year where divergence in central bank policies globally would become even more apparent. When will the Fed hike rates? That's the big question. Most of my guests during the show believe that it would happen somewhere midway through 2015, which is largely an opinion going by the consensus on the street and something the market has already priced in.
The Fed's been smart. This time last year it was all about unemployment levels when Yellen took over, and she's quite cleverly navigated the market onto thinking about the dual mandate, unemployment and inflation. The reason why that's important is because the inflation outlook looks very, very benign indeed, particularly with oil prices falling. That means that I think we'll see a more dovish Fed than many commentators think. I think we will see some interest rate hikes next year, but I think they'll be at the summer at the earliest, and maybe we'll only see 2, maybe 3/4 point moves, which actually, given the strength of the economy, is something which I think the equity market will be able to handle.
Then how do you react to the opinion there is on the market about perhaps 2015 not being a year when we see any rate hikes? It could be a 2016 story because the treasury markets are not reflecting any potential hikes as of now.
Yeah, I think the market's going to be pleasantly surprised, if I can put it like that, by the economic growth. I think we will see real increases in income growth, in wages. So that will be the pretext for early interest rate rises, but the inflation picture is always going to be a reason why the Fed, if it wishes to, can hold back.
Strong U.S. growth, moderate inflation, and I would say Fed is willing to take the first hike after 7 years in late 2015. And I do think this is a signal. But main topic here is I do think the Fed will communicate that nicely. Mrs. Yellen.
But they haven't even given a hint of that so far. They're saying that, it will be data dependent. We will keep, the policy accommodated for a while. And the treasury yields are not reflecting any such big move in yields.
No,
in rates.
You're right. Data dependent is a fantastic word. And I think let them or give them some leeway to act. And I think the tapering they have also done in the wording data dependent. And I do think if we're expecting 3.2%, unemployment rate to come down, inflation at some point to come down, but not totally going, the way down, sharply going to fall. You have to expect at some point that the Fed have to act.
We think they're on for 2015. So I think the market implied probabilities would tell you that at the end of 2015, US Fed funds will still be very, very low levels, 25, 50 basis points. We think it'll be somewhat higher than that. The FOMC dot plot's clearly expecting about 1.3%. This is as of September. That can change, as they have said they're very data dependent. But the data are employment data as well as inflation. I think we've seen much more positive employment trends. And I think the Fed will have a desire to renormalize monetary policy. I think they'll be thinking about putting rates up if they are, not to slow the economy down because they're worried about overheating, but simply to get back to a more normalized monetary policy. And yes, they'll have a view as to how that impacts the rest of the world and how it interacts, for example, with European monetary policy. If we've got very, very severe deflation in the rest of the world, that is likely to have an impact on US policy, but we still think we're going to see rises by the end of 2015.
But there are skeptics, mind you, to this view as well, who believe that the US rate hikes are actually a story meant for 2016, and we may not necessarily see the Fed move on rates at all through the next 12 months.
My view is that they won't move up on rates, that they'll be back with more quantitative easing, because the implications
So we'll have a QE4?
I suspect we'll have QE4. I don't think the economy is as robust as we think it is, and when it gets hit by these external headwinds, then it could come off quite sharply. There are people who think that actually what will happen is if we import deflation to America, it'll have a disinflationary boom that will encourage more consumption, maybe a little bit like the late 1990s. My view is very different. I think if real rates of interest go up, then economic growth is probably going to slow. Inflation comes down, nominal rates don't come down, real rates are going up. That's not what happened in the late 1990s. The Fed was able to cut nominal rates. I think fundamentally the baby boom generation is a completely different place and doesn't necessarily respond to the lower price of goods by consuming more. So I'm not optimistic on the United States.
I think interest rates will stay lower for longer. And I think the main reason is that we are in a situation where inflation, if you look around the world in the major economies, inflation is below target. Right? You look at the US, you look at Japan, you look at the Euro area, you look at China, the UK, this country, everywhere inflation is below central banks' targets. And that's despite the fact that we are now in year 6 of this economic expansion. And I think it's been a very special expansion, a very unusual economic expansion. I've called it a triple B expansion because growth is bumpy, it's below par, it's brittle. And I think this continues around the world. And so if you have a situation where growth is very bumpy and it's below par and it's brittle, and you have inflation below targets, then I think that makes for a very accommodative monetary policy stance. So I think the Fed will start hiking interest rates much later than the markets are currently pricing in.
Much later would be when?
Well, much later means sometime in 2016. The markets are now priced for the second half of 2015. We think the Fed will probably take until, say, the first quarter of 2016 before they start hiking interest rates. And even that may be optimistic.
In fact, the decision to hike rates depends on 3 critical factors. Sustainable growth in the US, which is at 3% plus annualized. This year, I think the expectation is 2.5% annualized growth. But we have to see, stepping into another winter season, how the numbers pan out. The unemployment data, which has been encouraging so far, the trend there at least, and inflation rate, which continues to be a key area of concern for the Fed as it's below their target level of 2%. So growth will be, of course, one of the key drivers. In fact, sustainable growth will be important for earnings as well to come in, which will support US equities from here. US equities this year have given a return of more than 10%, which has been very encouraging. But the outperformance in the equity markets will only happen if earnings growth follows up.
I think the bull market is going to continue. I think the one disruption that may take place will be the presidential election of 2016, which may sound like some time away, 2 years, but still I think that's the next sort of milestone that the US equity market will have to navigate. I think my sense at the moment is that the recent volatility that we had in the US equity market really meant that we were entering the second half of this bull market, but no more than that. In the second half, what usually happens is interest rates begin to tick up. I think that will happen next year. I think volatility, which has been low, has basically bottomed for this cycle, and that too will begin to trend higher. But I still think we can expect higher earnings, higher dividends and higher valuations over the course of the next couple of years.
There's not concern on valuations right now?
No, I really don't think that there is. There certainly some commentators take the view that the S&P earnings are inflated, they're at all-time highs, and if you cyclically adjust those earnings, then the US stock market looks very, very high indeed. I don't think there's any prospect for corporate operating margins to fall next year. In fact, I think margins are going to continue to trend higher. I think returns on equities is going to trend higher. And the reason for that is that labour costs in the US are low. Commodity prices are falling, and I think we're going to see further increases in the operating margin. As a result of that, earnings, I think on next year we're on 16 and a half times earnings. On 2016 we're probably at about 15. So I still think that both margins and earnings, and on top of that even multiples, can go higher. So I think before this next year, I think the market will get to between 2,200 and 2,300, and I'm even thinking that before this bull market is over, we could get to 2,500 on the S&P 500.
We think that the Fed's own growth forecasts for next year are too high. So the Fed expects something like 3%, maybe even more than that, GDP growth next year. We think we'll be closer to 2.5%. That will still be better than the last 5 years, but I think this will be a very moderate economic expansion next year.
Which means there will be no growth on a year-on-year basis, because 2015 also the expectation is roughly between 2.2 to 2.5% growth.
Yeah, that's right. Well, this year we started from a very low level, right? The first quarter was even negative. Now we have a pickup, but it would be no further acceleration from the recent pace in 2015. So in the third quarter of this year, in the fourth quarter, those two quarters together, we'll probably have seen 3% growth. Part of this is the catch-up from the very low first half. Next year, we are at roughly 2.5%. So no further acceleration in US growth. That's the first reason.
Sure.
Second reason, inflation. As I said, we are below target. We think that with the recent drop in oil prices and with no signs of wage growth or wage acceleration in the US, you'll see core inflation running below target until sometime late next year. We're at 1.5% now for core inflation, and we think we'll only get to 2% at some stage in 2016. And then there's a third reason, and that's the dollar. So we think the dollar will continue to be strong, will appreciate further. This is because Japan, Europe, and some other economies are trying to export their own deflation via currency depreciation. The dollar is appreciating, and that means the US is importing disinflation or even deflationary tendencies. And that means inflation will stay low, and so the Fed can be patient.
Right, the other big trade in lieu of rate hikes would be a big dollar rally, something we've already seen over the last 4 months. While comparisons with the 1998 currency crisis may not be clear now, as foreign currency debt in emerging markets is lower than where it was in the late 90s, those parallels are still being drawn. A big dollar rally would mean a weaker euro, a weaker yen, and also, of course, will have its impact in emerging market currencies. And most of my guests during the series pretty much voiced that opinion, that there was more upside for the greenback.
Why would the dollar be a strong currency? I think there will be an interest rate argument because there may be more divergence in monetary policy. But I think first and foremost, people want to buy assets in the US because the US economy is continuing to perform reasonably well. Now, not strong from an employment perspective, possibly, and I think that's created political challenges. But if you look at the performance of underlying assets in the private sector, they've done well. So I think it's a reason why people will want to buy dollars. I think it's not, as we've seen in previous eras, necessarily a response to risk. It's an opportunity that people are seeing in the US dollar. Now, historically, that's caused challenges in some emerging markets. And I think our assessment now would be emerging markets look a little bit different to how they were 5, 10 or 15 years ago. They may be a little bit more resilient to the dollar strengthening. Obviously, there'll be opportunities for those who are orientated more towards exports. And I think in emerging markets, those economies that have the strongest reform programs will succeed in attracting investor capital.
When you get a strong dollar, actually, it puts the really rapid changes in the world onto somebody else, and those people who are linked to the dollar. So I'm still of the same view that in the United States of America, it will also have another bout of deflation. But I see the real pressure for that coming from pain outside the United States, particularly in emerging markets, particularly in China, even through lower yen dollar selling prices from Japan. It's coming to the United States, but I think it's the dynamics building out there, lower commodity prices, higher dollar suggests it's going to start somewhere else.
For the dollar index, I think I don't have the number at my fingertips, but my guess is that we're looking for at least another 7% trade-weighted appreciation of the dollar. something between 5 and 10%, I think maybe about 7%. And some of these are quite big numbers. So euro dollar, for example, we see going to 112 in the course of the next 12 months.
Well, those are the key factors to watch out for in global markets for 2015. We'll take a break on that note, but when we come back, we will continue a summary of what my guests, some of the most influential global market voices, had to say about emerging markets and also India into the new year. Welcome back to Best of Global Mantra Market Outlook 2015 with me, Tanvir Gill. Now, most of my guests through the series had just one word for emerging markets. 2015 will be defined by reforms to revive growth and investments. Russell Napier, a financial historian, stated that high debt levels for certain emerging markets, especially Eastern Europe, could be a soft target for a potential default, the talk of which is getting louder with the current situation in Russia.
That these are the most vulnerable countries in the system. The real vulnerability is of someone who borrows in one currency to invest in another currency. That doesn't happen in the United Kingdom, the United States and France. People tend to borrow in their own currencies. But in the emerging markets, they tend to borrow in somebody else's. Now, the whole of Eastern Europe and Turkey, and to some extent South Africa, have borrowed so much money in somebody else's currency that it actually makes it probable that there's going to be a significant default somewhere in that region.
But would that happen in 2015? Is the risk of that higher in 2015, or do you think that's a story 12 to 18 months down the line? Very hard to say. I can't remember our exact conversation last year, but I suspect I was talking about Turkey. I mean, Turkey is the one that just keeps standing out. It's borrowed a huge amount in somebody else's currency. It's got a huge current account deficit. Somehow, somewhere, it is accessing capital to come in and hold the whole thing together. But what we've found with this in the past, with emerging markets, particularly in the Asian crisis, is that emerging markets can access all the capital in the world until the day they can't. Now, if you'd asked me this time last year, I'd say Turkey wouldn't be able to do it for another 12 months. So it's done it for another 12 months. Can it do it for another 12 months? Well, I don't think it can. However, other speakers didn't seem as worried about emerging markets, largely felt the story would continue to be each emerging market for itself. Hear them out.
I do think Asia, we prefer Asia in the emerging market country space. We are really on hold in LATAM. And we like India.
Okay. Are you increasing allocations to India?
We increased already.
Okay.
And I do
How much did allocations go up by?
We have in emerging market, we have overweight by 5%. And I do think India is for us, if India going to continue the reforms under the new leadership, I do think we are in a good place. Lower oil price is a huge driver for growth. It can really contribute to growth, and the cyclical sectors can be really nicely run, and that's our, I would say, in all the benchmarks, and we know that different weightings in different benchmarks, we would say clear overweight for us without question mark there.
I think you've got to look at it on a country-by-country basis. In the run-up to the Asian crisis, you had a number of deficits, both trade and fiscal deficits in countries, which meant they were dependent on external finance. The number of countries that are prone to that sort of challenge has certainly diminished. I wouldn't like to suggest it's zero, but many of those emerging countries are much stronger and able to withstand outflows. Now, you still have the challenge of outflows, and hot money going into or out of an economy is a serious challenge if you're trying to implement change. But I think what you'll find in 2015 is that those countries that have the most politically determined leadership and are pursuing reforms that will boost the long-term growth rate of the economy will be more resilient to that short-term hot money.
I think emerging markets have got their structural problems in front of them, and they still have to face up to those structural problems. And I think growth for emerging markets is going to be a continued disappointment. I think Chinese growth is going to continue to disappoint, and I think generally, particularly amongst the commodity countries, I think we're going to see weakness as well. The real axis for investing in emerging markets today is no longer around growth, it's about reform. And those countries which are committed towards reform and deliver on reform, those emerging markets will continue to outperform those which don't. And we've already begun to see that, and I think that's the real key for emerging markets over the next 2 or 3 years. The strong dollar is a clear negative for commodity-based emerging markets, and that is Russia, that is Brazil, and that is South Africa. I think other emerging markets can escape that as long as the reform agenda, which we just touched upon, is pursued and vigorously.
Well, given the dollar rally, for EM currencies, the intrinsic value of a currency would determine its direction over 2015. My guests believe that the intrinsic value of a currency is derived from the state of the economy the currency is representing, and that would mean that domestic fundamentals which largely drive the strength of the local currency.
From a macro perspective, India has been in a better position for really quite some time, and the people of India owe a great debt to its central bank for that as well, because they're a central bank who on the whole tended to stand away from the exchange rate. The temptation is always there to manipulate an exchange rate and believe that that's a free lunch, and it isn't a free lunch. And because you've always had more flexibility in the exchange rate, that's stopped too many people borrowing dollars. We all know that some people have, but it's barred too many people from borrowing dollars, and therefore leaves the currency flexibility there so that India can move forward by letting the exchange rate come down. And now in a deflationary world, that's actually easier, because we know that one of the real reasons that India wouldn't be that keen on a weak exchange rate is because of the inflation that would come through, particularly food inflation that would come through. So deflationary world is, if you had to be somewhere, it's better to be in India.
So especially for India, the rupee may have a stronger downward bias given the extended gains of the dollar and the broad wave of weakness that can bring about in emerging market currencies. But the domestic macros and the strong improvement in the economy will support the currency somewhat.
I think, again, we have to differentiate. I think there are some countries in EM that would actually welcome some further depreciation of their currencies, because it would help them to switch towards a more export-based system. I think there are, if you look back at last year at the taper tantrum, there were really 5 economies that were in EM that were hit in particular by the dollar strength and the higher US rates. And these were India, Indonesia, South Africa, Turkey and Brazil. Now, since then we've seen quite a lot of adjustment in India. So we think India has dropped out of these group of 5 countries that were most affected. Why have they fallen out? Well, first of all, the current account balance, the current account deficit has shrunk a lot. So India is now less dependent on foreign capital inflows to finance a current account deficit. And second, we have a new government with a pretty impressive reform agenda. So this is why I think investors would now give India the benefit of the doubt. Of course, the reform agenda still has to be implemented. That's the big question mark. But I think, again, investors are going to give India the benefit of the doubt. Plus, third point, India has a very credible central bank. And I think that also helps. So in that sense, I think the fallout, the negative fallout from dollar strength on India is fairly limited.
Breadth of the market does provide quite a lot of opportunities for investors to seek out value-based alternatives. So I think if we're overweight in India, and I can't say what will happen in 2015 because we do alter our weightings, month by month. It'll really be from a position of greater conviction that the reform program really is going to happen.
I would think
is the momentum
10 to
that strong?
15%, I can see it. I see that momentum, and I do think India is less vulnerable. Again, this time compared to 2013, from a stronger dollar, and might be also a change of the Fed.
Well, that was a quick snapshot, some highlights from my guests on Global Mantra Market Outlook 2015. The series, of course, continues with more views coming in from some of the smartest global fund managers over the next 3 weeks. As we wrap up this show, here's wishing all our viewers a very happy and prosperous 2015.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.